This is the Asia Trade. I'm Avril Hong in Singapore.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian equities are set to fall after a coordinated move by some nations to release reserves did little to stem oil price fears. Treasuries slide with traders expecting just one Fed cut this year. Oil extending gains as President Trump touts the release of emergency oil reserves and says the US is prepared to finish the job in the campaign against Iran.
And I'm Stephen Engel in Beijing. As China's National People's Congress winds down, officials here are intensifying efforts to boost domestic consumption amid a slew of challenges at home and abroad.
Now, on the touting by the U.S. president of the extent in which we're going to see the U.S. releasing oil reserves, we now have a number to it. The U.S. set to release 172 million oil barrels from the Strategic Petroleum Reserve, and this will take about 120 days to deliver based on the planned rates. The release will start from next week, and we're also hearing that the U.S. will more than replace reserves with 200 million barrels in next year. So we are watching out for how markets digest this, but note how even with the largest ever oil release coming through from the IEA and then Trump invoking some of these Cold War era powers to clear the way for renewed oil production off the Californian coast, we didn't see much of these oil market jitters being calmed, and this really being outweighed by the rhetoric from Iran that the chance for any truce has to be with guarantees that the U.S. and Israel won't continue striking. That's really playing out when it comes to the pressure you're seeing in Treasuries. They've been coming under pressure amid the higher oil prices, the worries about inflation. Of course, we did get February CPI numbers that came in bang in line. We're watching out for the Fed's preferred gauge later in the week. Markets have been pricing in one cut for this year. In terms of stocks overnight, we did see overall on an index level was flat, but there was a fair bit of churn under the hood. Haidi.
It feels like, Avril, at this point, no news is really good news when it comes to oil market sentiment at the moment, right? And to that point, we're seeing even just with the staggered open here in Australia, every single sector other than oil and utilities trading flat at the moment, but energy is really the only outperformer with the rest of this market trading firmly in the red after what was a couple of days of a sort of a respite rebound, if you will. If you take a look at Japan, we're also headed for some difficult trading there as well. This even as we've seen the Japanese government taking decisive action on oil reserves as well. Japan to release 80 million barrels of oil from its strategic reserves. Watching, of course, currency-wise, we're seeing that resurgence in the dollar again, but also the biggest annual jump in the Aussie dollar in 5 years as these petrocurrencies really continue to reign supreme. Well, President Trump saying that release of emergency oil reserves by the IEA would ease energy pressures while the US works to, quote, finish the job in its Iran campaign.
Well, it's only good if you win. You know, you can only do. And we've won. Let me tell you, we've won. You know, you never like to say too early you won. We won. We won the bet. In the first hour, it was over.
This as we see more reports about Iran launching a new wave of missiles towards Israel, according to these reports. But let's bring in our Bloomberg senior editor, Derek Wallbank, for the latest. And we know that there's always a lot of rhetoric to come from the president. He's talking about how they've won, but they need to finish the job and they won't be sort of leaving early or first. What do we know about where we're at with these operations?
Well, Heidi, I think let's take that a little bit in stages. Let's go for the oil stuff first. You know, the oil pricing pressures has been a key sort of global vulnerability now with the Strait of Hormuz effectively closed and some conflicting information about how closed it might be. There were media reports that Iran has begun placing mines in that. Trump again said that he didn't know that to be the case now. But remember, he has threatened Iran if that were the case and if they didn't take them out. So that's sort of one thing. But that pricing pressure in terms of energy has been a real vulnerability, right? We've seen a lot of production cuts among major oil producing nations in the region. So that's been a critical thing to watch for there. You're seeing this coordinated sort of strategic reserve release as an idea for how to try and gain a little bit more supply high volume there. There's some other things that the president has been talking about doing, some that he may have wanted to do anyways, like this project off the coast of California that he's been fighting with Governor Gavin Newsom about. Trump is going to try and push ahead with that. That's got a little bit of a limited supply, but even those sorts of things are ways to try and boost the narrative that there is more oil coming, that there's more supply that could be on the way. At the same time, we are seeing pressures across the world. We're seeing some supply constraints in Asia necessitating different workflows, some cuts that governments are implementing there. And, here in the United States, we talked about this yesterday, but this is an election year. Affordability is top of mind. Gas prices are one of the most obvious economic indicators in the United States, and the gas prices are up around the U.S. uniformly and by quite a lot. So there is a certain amount of pressure that the U.S. is feeling, even though taking all of that together, second part of that, Trump says that the U.S. is going to finish the job in Iran.
What does finish the job actually mean, given how there was lack of clarity on the goal to begin with out of the U.S. and at a time where we've seen the U.S. and Israel sort of diverging on what their end game might be, the IDF now saying that it started wide-scale wave of strikes in Tehran. What does this mean ultimately for the prospects of any form of truce at this stage?
Well, Avril, right now we're not hearing any indications from the U.S. or Iran that either side are really looking at a diplomatic off-ramp here. So let me start with that. We're not seeing indications that either side really wants to have talks. We're not really seeing anything that's being laid out by either side yet about sort of platforms by which the other might find acceptable that would be considered an off-ramp. And we were hearing out of Iran that they want the U.S. to stop, to pay reparations and get some international guarantee that would prevent a further action coming again. I mean, there's no chance that Donald Trump wants to pay Iran reparations. So, right, some of those things are non-starters there. At the same time, Trump and his administration have made very clear that they see themselves having the upper hand here. Trump even goes so far as to say, we won very early on in this. The news out of the Pentagon, the statements out of the White House are all uniformly very, very positive about what they think the U.S. capability is, what they think that the U.S. performance has been, as well as what they think that the U.S. relative capability to continue to prosecute the actions in Iran as long as they want, as hard as they want, wherever they want. And so you're not really seeing off-ramps there in really either side, right? So where do we get to a point where we pause here? It's very hard to say right now. I do think that this is one of the critical signals that markets are watching for, but you're seeing even sometimes in the same remarks from the president, indications that this will wrap up quickly, but also indications that the U.S. is prepared to go as long as it takes, and putting a day, a week, a month, a whatever time frame on that has proven very elusive so far. It's really so far been a guessing game in terms of how long this is going to go and what the conditions will be required to finally bring it to a conclusion.
Derek Wallbank, the Bloomberg senior editor, with the latest. And joining us now to take a look at the market implications is Dilin Wu, who's the research strategist at Pepperstone. Dilin, great to have you with us. And so, as Derek said, at this point, there's no sort of real opportunity or sight of an off-ramp for either side. Clearly, releasing more supply into oil markets is not releasing that oil premium from investors either. So how do you kind of view this energy-driven shock? Is it a temporary hit? Is it the beginning of something more structural and problematic?
Well, I stay really cautious about calling it a sustainable pullback in oil prices. I mean, some of the headlines may have briefly lifted market sentiment, but they are far, far away from enough to justify a lasting decline in oil. I mean, on the geopolitical side, Donald Trump just suggested the war could end soon, but Iran has hinted that the reciprocal strikes could turn into continuous strikes, and it's also taking a very hard line on the reopening of the Strait of Hormuz. So at this stage, we're really not seeing any clear signs or signals of this kind of de-escalation, and the geopolitical risk premium is still very much alive. And then let's come to the strategic reserve story. So the IEA members have agreed to release about 300 to 400 million barrels, which sounds like a big number, but when you really run the math, it's actually quite small compared with the potential disruption from Hormuz. So roughly 20 million barrels pass through the Strait of Hormuz every day. So even in a very, very coordinated scenario, those reserves would only cover about 2 to 3 weeks of supply. And that assumes a perfect release, which is quite unlikely from my perspective. So yes, reserve releases can ease price pressure for a while, but they can't really fully offset a large supply disruption. That's why we only saw a brief pullback in oil after the headlines.
Dilin, as we're speaking, we're also being reminded that trade still remains a major uncertainty for investors and the markets as well, right? To that end, the US Trade Representative's Office has begun a Section 301 investigation totaling 301 probes related to manufacturing sectors in 2 countries, including China, the EU, Singapore, Switzerland, Norway, Indonesia, Malaysia and Cambodia and Thailand also among them as well. A hearing will be held on May 5th, but they've requested consultations with the economies that are under investigation. This comes as we're looking at a series of new trade probes after, of course, Donald Trump's so-called reciprocal duties were struck down by the US Supreme Court. So this is just another reminder that that tower of war, that the trade uncertainties remain, even as we are contending with war and an energy crisis as well. So with all of the uncertainties, not to mention the implications on global growth and inflation, are there markets or sectors where you see places that investors could potentially find respite or a place to hide while all of this is playing out?
That's a really great question. And first of all, I think apart from the high volatile energy sector, I think the tech sector, including the US tech equities, are quite resilient at the moment. In the first place, people are putting many of their capitals into the Asian tech sectors, including some of the memory chips and storage name. But at the moment, because US is less reliance on this kind of energy input, and also we're seeing great corporate earnings from the previous Q4 earnings season. So I think we can potentially looking into some of the buy the dip opportunities in US equities. But that said, we really need to looking into the potential development in the geopolitical side. If we are seeing a sustained elevated oil price, then the inflationary pressure can come into the US market, and that could potentially add burden to the bullish sentiment.
Dilin, does that mean that when it comes to the dollar, some of these tailwinds from the US being an exporter of energy are going to offset the trade risks ultimately?
Well, I think that's a fair call. I do have a cautious optimism about the dollar's further testing to the upside. I think 3 key factors are currently supporting the dollar performance: rising safe haven demand, higher inflation expectations alongside climbing treasury yields, and also the possibility that the US could emerge as an alternative energy supplier. The third that reason is perhaps more interesting here. As the world's largest oil and gas producer, the U.S. may actually gain a relative advantage when we're seeing some of the energy facilities in Saudi, Qatar, or Israel face disruptions and shipping through the Strait of Hormuz becomes somehow constrained. Markets are starting to pricing in a new narrative, which is the U.S. could step in as a stronger alternative energy supplier. I think as long as inflation expectations remain elevated and geopolitical tensions persist, the downside for the dollar may remain quite limited.
Where does this leave Chinese assets, Dilin? What's been interesting is China's been seen as a sort of haven amid the war because of its energy reserves. Then we're looking as well towards the end of the month where Trump and Xi are set to meet. You have these tariff developments. China is part of some of these investigations. What are you seeing in terms of the trajectory for Chinese assets?
Well, I think I'm quite bullish on the Chinese asset, although from the NPC just concluded China's revised down its 2026 GDP target, and it was set from 4.5% to 5%. And, some people are concerned about the economic outlook for China. But I think it's basically the government saying we're okay with moderate growth if it gives us more room to push through structural reform. So market shouldn't, to be overreacted to the headline number. The focus is still on the policy direction and the room it creates for longer term transformation. So at the moment, I think China is pushing forward to transform from solely rely on export and the infrastructures to more on the high-end tech and this kind of development. So I think I'm quite bullish on China as long as it can find another driving forces to boost their domestic economy and consumption.
Dilin, great to chat with you this morning. Thank you so much. Dilin Wu is research strategist at Pepperstone. Now, coming up on the Asia Trade, our exclusive interview with Seagate's Chief Commercial Officer as we get the outlook from the data storage giant. Plus, Bernstein's Director of Research will be with us to talk oil and why they think we're nearing the end of the Iran conflict. More ahead, this is Bloomberg. China's annual two sessions meetings wrap up today. Beijing set a GDP growth target of 4.5 to 5% for the year. That's the lowest since 1991, while vowing to intensify efforts to boost domestic consumption. Bloomberg Chief North Asia correspondent Stephen Engel has been tracking developments for us all of the past week or so. Hey, Steve. We've been, as you highlighted, looking forward as these meetings wrap up towards the Trump-Xi meeting. I mean, we've just heard the USTR is going to investigate the Chinese for tariff-related issues. I mean, what are you watching now?
Well, I think there is, merit to say that the attention is going to be focusing, pivoting to that summit that's coming up, scheduled at least at the end of this month and into early April between Xi Jinping and Donald Trump. As the National People's Congress, the annual session of Parliament, wraps up this afternoon. There's a lot of technical and protocol issues to be dealt with today inside the Great Hall of the People, essentially formalizing and approving the 5-year plan through 2030. 30-year plan, that'd be quite ambitious. And also, of course, essentially approving the marching orders for this year from the work report last week. And the main themes really are building self-sufficiency into this economy, building domestic AI and investing more into that, building domestic chips and the like. So technology is a big focus, as well as what you just said, domestic consumption. And that's what I essentially dove into over the past week to find what are the challenges and what are the opportunities to building this domestic economy.
China got a record bump in Lunar New Year holiday spending this year, but that's seasonal, not necessarily sustainable. Hence, Beijing's top priority in the next 5-year plan through 2030 is to boost domestic demand. Sure, we've heard such calls for rebalancing before, but with rising uncertainties abroad and excess industrial capacity and falling prices at home, Beijing is, well, banging the domestic consumption drum harder than ever. An hour's drive from central Beijing and the seat of power sits the largest outlet mall in northern China. Opened in December, the sprawling Wanli commercial and entertainment complex is a gigantic bet that physical retail is not dead.
Like many things in China, this place is absolutely huge.
It's 5 million square feet of outlets and leisure space spread over a suburban footprint equal to 64 American football fields. Sure, there are the usual Western brands, but also many homegrown names most outside of China have never heard of, as Beijing further pivots from its made-for-export model. Where traditional malls are seeing rising vacancies, discount destination outlet malls are springing up nationwide. President Xi says China must fully leverage the advantages of China's, quote, super large-scale market, aided by sizable investments in AI, to boost the sale of goods and services.
I think one of the challenges of boosting consumption as GDP is Chinese are never going to spend like Americans or Europeans, so we don't quite know what the number should be. I think, to your point, AI will boost also the service sector. That's really the game changer.
Still, there are significant hurdles to overcome. Authorities, for one, are ordering an end to price wars in everything from EVs to food delivery, a deflationary spiral that's hurt corporate profitability and therefore employment, and therefore household consumer confidence that's already been sapped by a years-long property crisis.
If you look at the experiences of other East Asian economies, successful ones like Japan, consumption share of GDP increased over a very long period, like 3 to 4 decades. So we shouldn't expect that the consumption problem will go away immediately. This is why the government needs to focus more on income and the confidence of the households.
No wonder leaders are targeting GDP growth this year of as low as 4.5%.
There's so much chaos in the world. We have wars in multiple places. The U.S. is a bit unstable politically. China just wants to make sure that it can continue to maintain growth.
Especially with what we are seeing at this moment, perhaps the most unwelcome form of reflation, soaring global oil and gas prices.
And like the rest of the world, I think this potential for a prolonged oil shock is a big risk to China. It's a double-edged sword. Malcolm Scott on the Bloomberg Terminal in the Economics Daily has a great take on this. Essentially, that double-edged sword is in the interim right now, the global spike in oil prices could kind of jolt China out of its deflationary spiral that I talked about there. But if it's a prolonged oil shock, this could obviously, like the rest of the world, pose more longer-term structural problems for China. So China is completely watching this very closely, already ordered its refiners here to not export its refined oil products, gas and diesel and the like, and rely right now on a lot of their strategic reserves as the Strait of Hormuz obviously has ground to a halt.
Bloomberg Chief North Asia correspondent Stephen Engel there in Beijing. More ahead on the Asia trade. This is Bloomberg. Take a look at some of the movers, and we are seeing really only energy stocks. Some utilities names are trending to the upside in the Australian session about half an hour into the start of trading. The likes of Santos, they're up by 7.5%. We're also seeing 1.5%, I should say. We're seeing Woodside Energy also putting on just about 1.25%. Oil continuing to extend its advances. The sort of Iranian rhetoric is outweighing the release plan that we've seen from a number of different countries. We're seeing a second day of gains for crude. Another volatile session overnight over the escalating comments over the Iran war, raising more concerns that this is a conflict that doesn't have an easy off-ramp as well. The US, on its part, announcing plans to release 172 million barrels as part of this coordinated global effort to cool prices. This is Bloomberg.
This is a major action aiming to alleviate the immediate impacts of the disruption in markets. But, to be clear, The most important thing for a return to stable flows of oil and gas is the resumption of transit through the Strait of Hormuz.
IEA Executive Director Fatih Birol on their decision to release 400 million barrels of oil reserves. And as part of that plan, the U.S. will release 172 million barrels of oil from its emergency reserves from next week in a bid to ease surging fuel prices amid the Iran conflict. The release will take about 120 days to be fully delivered. President Trump has vowed to refill the reserve after the move. Now, Japan will also release 80 million barrels of oil from its strategic reserves to deal with the fallout of the war in the Middle East. Our economy and government reporter Yoshiaki Nohara joins us now from Tokyo. Yoshiaki, talk to us about the plan from Japan and what it tells us about Takaichi's efforts to deal with the energy shock.
Well, it's important to note that the Prime Minister made that announcement ahead of the IEA's decision to do that oil release jointly. So it shows that how fast and decisively she's moving to tackle inflation here, because gasoline prices matter to the livelihood of the people, and therefore it matters to whether she can maintain high popularity among the public after the big election win.
And that really goes down to the implications for the economy as well, right? What does this mean for the Bank of Japan, for the inflation outlook?
You know, it's a very delicate, complicated situation for the Bank of Japan because of the risk of the stagflation coming up because of the rising oil prices in the Middle East. But this move by the government is probably relieve some pressure on the BOJ to act immediately because the prices are being, government is planning to keep the gasoline prices low. So that means that inflationary pressure is going to be kept somewhat moderate because of the government spending. So that means that the Bank of Japan doesn't see the immediate probably need to raise the interest rates again. Definitely not later this month, next week. Definitely no.
Yet, Yoshi, for the Japanese public, they had already been dealing with cost of living pressures prior to the war. I mean, I wonder to what extent these moves to release reserves are going to ease the domestic anxiety.
You know, that's a really big question because it ultimately comes down to how long this war and conflict in the Middle East will continue. And that's why Prime Minister made it clear that she is going to be flexible to make sure that this kind of a price relief for gasoline prices will be maintained in a sustainable manner. So, but we don't know how long it is going to last. So I guess the government is decided to act proactively to show they are doing something about this for the public. But in terms of how long it's going to continue, how much it's going to cost for Japan, we don't know yet.
Yoshi, thanks for walking us through this. Japan economy and government reporter Yoshiaki Nohara. Now, we keep coming back to this, how long the conflict is going to last. And as governments scramble to allay the energy price shock, we've, of course, been seeing at the top of this hour the U.S. committing to 172 million barrels release. Now, oil is still hovering at around the 93 level on WTI, the U.S. benchmark. So it goes to show how the jitters haven't really been calmed. And despite the move from multiple nations, Carlyle Energy Pathways Chief Strategy Officer Jeff Currie believes no policy response can stop crude's ascent. He also warns the damage from the war could take months to unwind.
You've disrupted global supply chains. This is not just a disruption of oil. It's gas, it's fertilizers, it's metals, it's petrochemicals, the list goes on. And then you've disrupted supply chains in countries all over the world. The ships are in the wrong places. The insurances are being canceled. You've taken the pressure out of the fields that you've shut in places like Saudi Arabia or Iraq or even in the UAE. The list goes on. The damage is going to take months to unwind. But I want to bring it to the immediate. There is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. You know, the maximum sustainable flow rate is 2 million barrels per day. So 400, that'll take them 200 days to get that out. And you put that in the context of a disruption of, let's net it out of this, it's got to be somewhere around 18 million barrels per day right now. You're just minuscule in terms of offsetting it. So again, there's not many options here.
What would you call this then? A PR campaign?
In terms of doing this, it's all they have. They're going to do whatever they can. But I think the key issue here, keep the hoarding down. Because we know what happened in the 1970s when you got the hoarding. It created an increase of demand of somewhere around 2 million barrels per day. In the size of this market, try 3 million barrels per day.
Carlisle Energy Pathways Chief Strategy Officer Jeff Currie there speaking with Bloomberg. Well, still ahead, we have more on oil a little bit later on the Asia trade. That's when Bernstein's Director of Research will be joining us to discuss that market volatility. That conversation is happening in the next hour here on the Asia trade. And of course, lots of questions, more questions than answers as to where this oil trade goes, because despite this pretty coordinated global strategic release of reserves, we haven't seen much calm being restored to these prices. The Strait of Hormuz really remaining really the first order issue for these markets and investors, not just for crude oil, but across other assets as well. This, as we point out in our MLive blog, is really about how many barrels can move safely and consistently through that choke point. So, Avril, it's not just how much oil there remains, but how much can actually be transported, of course.
Yeah, and with that choke point, as you highlighted, through the waterway flow rate, that's exactly what Jeff Currie just highlighted. I mean, take a look as well at the cross-asset implications, given how the energy shock is playing out in inflation expectations. The weight is there on Treasuries. You're looking at the US 10-year at the close at around 4.22, and increasingly that correlation with oil prices. Think about as well how we are watching out for the U.S., the Fed's preferred gauge of inflation later in the week. Markets have been pricing in just one cut following on from the U.S. CPI data. You're looking at U.S. 10-year bond futures pointing to further declines at the open. And amid all this, the dollar is standing out. It's continued on its upward climb. That trajectory seems clear given the U.S. position as an exporter of energy. So interesting to see that along with some of the moves, including on the Japanese currency as it weakens past the 159 level. Haidi?
Well, as you say, Avril, the inflation picture continues to get murkier, and I want to bring in Garfield Reynolds, who leads our MLive Asia coverage. So, it's interesting that this is not about supply being released. It is about, essentially what happens to the Strait of Hormuz, and for that we have no more certainty given the back and fro that we're hearing.
Well, I mean, at the moment we kind of have certainty, which is that it's not going anywhere. There's no real movement through the Strait of Hormuz, and there are reports of ships hit yesterday and possibly quite recently. That's unconfirmed, but there is chatter on that. And we have a definitive release from the US Strategic Petroleum Reserve. We have the plans to release much more, 400 million barrels, from the IEA that are being considered. But one of the concerns there is how much is going to be crude, how much is going to be product, how rapidly will those barrels make their way to markets, and to which markets. But even more of a problem for global markets is the fact that even at those levels, if you're talking about something like 3 to 4 million barrels a day coming onto world markets because these reserves are released, that still pales in comparison to estimates of at least 12 million, maybe 16 million barrels a day that are definitively off the market because of both Iran's barrels mostly being off the market, but more importantly, again, the Strait of Hormuz being shut, and every day that it is shut is another day when you're going to get existing production from oil fields initially shut in, and then eventually they'll be shut down. because storage is filling up and you can't just keep the taps open unless you've got somewhere to send them.
And in the meantime, we're seeing, of course, not just obviously the cross-asset impact, but the Treasury, the bond sell-off in particular.
Yes.
Is this becoming a structural issue?
It is becoming a structural issue. The structural issue is that just simply inflation is back, and that both means that the traditional inflation concern for bonds is there. Also, central banks are going to be forced to be hawkish. We've got a very good chance that next week the RBA will hike rates. We've got rate hikes being priced in for the ECB, the BOJ. Even the BOJ may be forced to act earlier than it might otherwise do so, because if it doesn't, the yen is going to drop remarkably, and that will bring inflation back into Japan and will hurt bonds anyway. So you've got all of that going on. Bonds are no haven amid this. Even gold is no haven amid this, it would seem. It's down slightly. Flows are going into the dollar. And otherwise, investors are probably saying, if I'm going to take shelter from this, I'm just going to take shelter in cash.
Garth Reynolds, who leads our Live Asia coverage, and Garth makes a good point. We're now in that verbal intervention zone for dollar yen, so something else to watch this morning. More ahead on the Asia trade. This is Bloomberg.
Qatar's shutdown of LNG production has taken about a third of global helium production offline, and that's affecting chip makers who rely on the material for semiconductor manufacturing and the supply for critical memory chips. With AI's demand for storage accelerating, though, one company providing such solutions for customers is Seagate Technology. Its Executive Vice President and Chief Commercial Officer, Seng joins us exclusively from Tokyo. Seng, really good to have you on the program. We are, of course, watching out for the memory demand and how that has also been accelerating parts of your business in terms of storage and how that's looking really solid. But talk to us first about the impact you've been seeing potentially or foresee from the war in Iran in terms of, are you expecting any affected shipments from helium supplies?
Well, good morning, Avril, and thank you very much for having me. Yes, AI certainly is, it's hardly a situation that you don't talk about AI in any tech conversation. Storage, as you had mentioned earlier, is certainly growing. Our customers and their customers are demanding for more and more storage devices. And more than 80% of the storage that's in the market today is actually stored on disk drives, which is the product that we sell. Right now, there's an unfortunate situation. I'm glad to say that in the short term, the impact to our business has been minimal. Yes, we do rely on supply chain and some of the helium products that you mentioned earlier, but at this point in time, we have resiliency in our supply chain that is buffering us from any short-term impact.
How long is this resiliency going to last, Seng?
Well, I think we're looking at several other options, and at this point in time, we don't feel that is going to create any meaningful impact for us.
Seng, when it comes to capacity, how comfortable are you at the moment when it comes to that balance? Because obviously you don't want to get into the position of aggressive overcapacity, but when, if at all, do you see a ramp up?
Haidi, thank you. That's a really good question and something that we talk about quite a fair bit. We believe that the market is growing at a rate of, the consumption is going at a rate of 20-25% a year CAGR over the next few years. Certainly, we are well positioned to support the market with that capacity. But really, at the end of the day, right, there are certain factors that we have to pay attention to, macroeconomic factors. But at the same time, there are also exciting new applications coming onto the market, which could drive that demand up even more.
What about enterprise and mid-market sectors? Is there a concern that they're going to be priced out?
I think that overall, what we're looking at is a situation where the return on investment is far more significant than any meaningful increase in cost and price today. AI is certainly an initiative, or I would call it even a market momentum that is unavoidable. Nobody can not invest in AI today because the payback really from executing and what do you call that, getting AI to really create meaningful efficiencies and benefits to the company is too big to avoid.
So does that mean that you are confident enough to aggressively ramp up capacity? And if so, can you share some numbers with us to extent of how much?
No, Avril, we are looking at a market growth, as I mentioned earlier, of about 20-25% CAGR over the next few years. We believe that the market certainly will grow at that pace, and that's something that we're preparing for. But more importantly, it's how we're actually supporting that need, and it's through technology. We're not increasing our unit production and to produce more units, but how we're getting the capacity out there is through technology, which is creating higher and higher aerial density in a single disk drive. We've just announced recently a 44 terabyte drive per unit, which is much higher than the existing that's being shipped in the market today, which is about 32 terabyte. This gives our customers up to a 47% efficiency and total cost of ownership reductions. And that's really going to be very, very meaningful in the next few years.
It sounds like you're in a pretty good position then. What about price hikes? Is that something that is on the cards?
Well, the prices have risen in the past, I would say, 18, 24 months. What we believe and expect is that the supply-demand situation is such that the prices will be stable. And by that, I mean it's going to be probably flat to up over the next few years.
There are a lot of concerns about bigger volumes required by AI and the emissions burden, right? Do you have an answer to that?
No, absolutely. We believe that the demand for storage will grow. AI is a big driver for that, and AI storage is really the foundation of all AI applications, really, right? Whether it's for training, whether it's from data that's being created as a result of inferencing and getting the applications to work. Data becomes more valuable, and as the data becomes more valuable, you have to store the data, and that's really driving the demand for our products and related storage products as well. So yes, in short, we believe that the demand will continue to grow.
When it comes to real-time AI agents, as the technology changes and progresses, are the needs also changing when it comes to storage capacity?
Yeah, so agentic AI certainly is one of the drivers as well, because with agentic AI, it actually increases AI workloads and applications exponentially as well. And that in turn would really increase the demand for storage and the creation of data, and the creation of data really increases the demand for storage.
Seng, really great to have you with us. Bernstein, who's the Executive Vice President and Chief Commercial Officer at Seagate Technology. We have more ahead here on the Asia Trade. This is Bloomberg.
The latest from the corporate front, financial stocks in the US exposed to private credit slipped as a spate of redemption requests rattled markets. Apollo says it's now ramping up efforts to give its investors more regular insight into the value of its private credit holdings. Meanwhile, Morgan Stanley capped redemptions from one of its private credit funds. That's after it returned about half of the capital their investors sought to cash out. Shares of Atlassian rose in extended trading after the enterprise software maker announced plans to cut about 1,600 workers. In a note to employees, CEO Mike Cannon-Brookes said the cuts, which amount to about 10% of the company's workforce, are about adapting to the AI era. The maker of collaboration tools such as Jira and Trello has seen a steep sell-off this year, losing more than 50% of its value through Wednesday's close. Japanese digital wallet provider Paypay is said to be planning to price its US IPO at $16 per share, below its marketed range. At that price, Paypay would have a market value of about $10.7 billion. Sources say the Softbank-backed company is poised to price about 55 million ADRs, putting the deal on track to raise $880 million. Sources say Netflix will pay as much as $600 million for Interpositive, the AI movie-making company founded by Ben Affleck. It's one of the largest AI deals by a major Hollywood studio. Bloomberg's been told the actual price paid in cash was less, but its owners will earn more if it meets performance targets. Interpositive develops tools that allow filmmakers to alter existing footage. Haidi?
Well, there's only one story in town, and it is crude, what we're trading at and how it's impacting cross assets, right? And we've seen that coordinated release from a number of different countries, and it's clearly not just about supply, it's about the transportation through the Strait of Hormuz and that choke point that this market continues to trade on. But taking a look at how we're seeing when it comes to the start of trading in the next hour, in the next few minutes or so in Japan and Korea, we are seeing some pretty firm downside. Both of those future sessions pointing to losses of around 2% for cash markets when they come online shortly. That could just be the beginning of a pretty hard day as we see oil continuing to rise. We heard President Trump speaking just a few minutes ago, talking about the strategic reserve. The SPR saying they will fill it up and will do it very quickly. Again, not a great deal of detail. He said when it comes to Iran, they're in good shape, but Avril, just the sheer amount of uncertainty is what's at play here.
Yeah, and as these oil prices remain at elevated levels, you do wonder the extent in which any rebound continues on Asia stocks. You're looking at them coming under pressure, at least the way in which futures are pointing both for South Korea and Japanese markets at a time where S&P 500 futures are already showing us that the rebound a short day ago, perhaps not as long lasting. Markets open in Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, which by all accounts, if you take a look at the futures session, looking like it's going to be quite a challenging start to this Thursday session here in Asia. Both Korea and Japan looking to come under pressure, Avril.
Yeah, and you know how the oil prices still have been trending higher despite the extent in which governments have been scrambling to release reserves and try to calm some of these oil market jitters as well, Haidi.
Yeah, and of course, we've seen WTI pop about 7% at this point, despite the strategic release of these reserves by a number of countries in a pretty coordinated effort. We're not seeing the markets really focus on that positivity. We're seeing them focus still on that unresolved choke point of the Strait of Hormuz. And on that point, we're not seeing much progress when it comes to the end of this conflict in the Middle East, with President Trump also saying that they would not be leaving early, that there's still more work to do. We're still seeing signs of conflict, of course, even so far this morning. Take a look at the open. We're seeing downside there when it comes to trading in Japan. The Nikkei 225 down by 1.2%. Another indicator that was going to be to the downside was that we saw S&P 500 E-minis as well as the Nasdaq 100 slumping 1% or so. So that really kind of confirms that this cash session is going to be quite difficult for this part of the year. Investors also facing still concerns about strains in the private credit market, as well as the US now opening another round of trade probes into various trading partners as well. Also watching dollar yen, this as dollar supremacy continues to play out. We've also seen that strength of the Aussie dollar against a year as well at decades highs. And we're in that intervention, the verbal intervention zone from officials when it comes to the yen today. Switch out the board and take a look at what we're watching in Korea in particular. And of course, that tech story also continues to play out. We've seen kind of sideways trading in tech and the Mag 7 in particular in the US, but at the moment, the Kospi off by 0.8%. Some weakness across the Kosdaq as well, Avril.
Yeah, Haidi, it's really about these oil prices underpinning inflation concerns. That's put pressure on Treasuries. You're seeing the US 10-year popping on the yield back to 424 levels now. And Brent has opened with gains of about $97. There's where you're seeing it. Against this backdrop, of course, that risk appetite perhaps curtailed to some extent. Joining us now is Hartmut Issel. He's head of APAC Equities and Credit at UBS Wealth Management. Hartmut, good to have you in the studio. So I think your view is that there's still opportunities out there, even amid these risks. But talk to us first, the extent in which you see oil prices being a headwind for the near term.
Yeah, for the very near term, certainly it's possible. But if I line a little bit, right, also interest, right, of the different actors in the region, right. So you have the let's say oil importers, right, and certainly there is an interest to have not too high oil price and especially to have the flows relatively steady and the capacity steady. And even if you're an exporter, so more in that region itself, right. If you're a government, yes, maybe you have more interest in a somewhat higher oil prices, but you need the revenues, right. So that means you need the capacity and you need to ultimately ship it out. So I think, the likelihood that maybe in 6 or 12 months from now, I come back and we're talking still about the same topic in the same magnitude, I think is rather low. So base case is, yes, temporary, but more on the shorter side, we think.
So you don't think there's going to be that much of an inflation read-through?
Then ultimately, if it's a temporary one, it shouldn't be, right? And also, I know there's a lot of discussions about inflation and oil prices, etc., right? But as a central bank, right, you would also check first, is it coming from the demand side or is it more coming from the supply or possibly supply shock? So you would respond also a bit differently to that, right? And then there's also other factors, maybe labor market, etc., in the US, right? So whether really, right, we see the Fed stopping here or even going up, I think it's doubtful. We think still it goes further down this year in the Fed rates.
How many cuts are you thinking, and how does that affect the way you look at assets?
We still think it's more likely than not it's going to be 2 cuts, right? We have, let's say,
market's pricing 1 now for the year.
That is correct, right? But we're sticking with our 2 at this point, right? So of course, then the question often comes on the equity market. We still think, right, double-digit earnings growth, even in the US, certainly here in APAC, even more, right? And I struggle a bit right now. Yeah, we look at the oil price, etc., right, to really bring it down very meaningfully. And if not, right, we have seen a bit of pullbacks in markets. Then why wouldn't we take also advantage of that side?
Hartmut, it's interesting you talk about the inflation aspect. We've just gotten the inflation expectations for Australia coming in at 5.2%. We're seeing market pricing when it comes to 3 hikes from the RBA now at around 90%. A lot of this pricing has moved very rapidly just in the last few days or so. Do you think that these market expectations are getting ahead of themselves, or is this kind of an indication that we're going to be in for a rough ride?
Yeah. Again, when we take maybe the headline and the core also a little bit apart, and it's maybe not too surprising, right? If we do see oil prices going up, of course, the inflation expectations as such, right, in the minds of many, especially also consumers, that's not too surprising. But again, I also mentioned, right, we look at just a few steps back, right, labor market in the US, etc., right? Do we really think inflation becomes a major issue here over the next couple of quarters? I would still doubt that.
I think for the US, it's a particularly difficult position that the Fed finds itself in, right? There's still the political element as well as to what the administration might do if they do actually move. But at the same time, this morning, as if the oil story was sort of big enough, we're also getting the announcement of another round of trade investigations from the USTR. The trade and tariff story is not over yet for the markets.
You can argue that, and also at geopolitics, yes, we have that certainly in our picture. Let me also say, always right, also reserve a bit of gold, for example, in the portfolios, right, so that you really mix it out. But I would still argue, right, in terms of where it impacted the markets the biggest, I think we've seen the highest impact of that probably almost a year ago, maybe let's say April last year, right? That doesn't mean all these discussions are finished, right? But the biggest pressure that we had on markets, I still would argue we're already quite a way through that.
We are seeing yields trending higher though. I mean, for AI and investments in tech in Asia, do you see the prospects of higher borrowing costs potentially as a headwind?
Higher borrowing costs, if they stay here, which is not our assumption, right? We think, for example, I'll give you one, the 10-year, for example, in the US, right? We think, right, given also where the economy goes, right, and that probably this year, inflation still being a bit on the high side. Next year, we think it goes down. We see it below 4%, right? So from here should go down. But be that as it may, what I always watch, and we will see very soon in a couple of days, also by the way, the China side in AI, right? So what I tend to always watch is what is the end demand, right, for cloud services, for example. Most of it, or a lot of it, is AI, right? We see the US hyperscalers, everybody in high double digits. We will, I would argue, also see the Chinese ones again in high double digits, especially the private ones, I would think, right? So it's a bit hard to say, okay, right, the interest rate side derails all of that. I mean, if the demand is there, as we see, this is evident in the data, I don't think that goes away anytime soon in the next couple of quarters. So this is still an interesting part of the trade.
So it sounds like you're still quite constructive on risk assets and maybe not enough in the way in terms of headwinds for those asset classes. But you see gold at 6,200. Like, how do you square that away?
Yeah, and we can also see this a little bit as a hedge, right? Because there is, let's say, my forecast isn't completely accurate. Maybe we go 6-9 months into things like geopolitics, etc., right? And we have a midterm election coming up. All these things, right? It wouldn't be surprising that we see, especially also in the view of the Feds going down a bit more, right? You would expect actually the demand for gold to be not only steady, but to be also relatively strong. And if you have more, we just heard again, right? So trade discussions, etc. When you have all these things, that it also means you shouldn't expect gold actually to even be stable. We think there is more upside also for gold. So next to an equity side, to a quality bond side, you also want a third pillar in the portfolio, which is gold.
But this is quite a distance between where we are now on gold to 6,200. So does that mean that the risks are maybe more pronounced from here on out?
Or at least they stay this way. Right? Because even if we get solutions Middle East, right, there could be other things happening, right? So we have seen quite a number of discussions in the last couple of quarters. It's not so easy to say that all of these will go away. And on top of that, right, if the Fed even just goes one down, but certainly as we think two down, right, you would also think why not also pave the way a bit for gold. So these are some of the drivers.
Hartmut, always great to have you with us. Hartmut Issel, Head of APAC Equities and Credit at UBS Wealth Management. Take a look at what we're watching in terms of the movers, and essentially there's one story that's on the way up, and it has really been energy, right? We've seen about a 7% pop when it comes to WTI in the session. This as despite President Trump touting the oil supply moves, the release of emergency oil reserves that's supposed to ease energy price measures, but we've seen that strategic release from a number of countries really not make much of an impact on oil prices at the moment. But in addition to some of those early gainers here in Australia like Santos and Woodside, we're seeing in Japan and Korea names like Impex also joining that very limited rally for these broader markets. Well, President Trump says that emergency oil release by the IEA would ease energy pressures, and the US is working to finish the job in Iran.
Only good if you win, you can only do. And we've won. Let me tell you, we've won. You never like to say too early you won. We won. We won the bet. In the first hour, it was over.
Let's bring up Bloomberg editor Michael Heath. So he's spoken at a number of sort of points today. We've won, but there's still more work to do. We've got to finish the job. They're not leaving early. All of this is certainly not giving markets much to go by in terms of the time frame at all.
No, Heidi, and when in some of his other comments, when he's talking about how they're being successful, he seems to be sort of implying that they've hit most of the targets that they were intending to go after, which doesn't equate to victory. Obviously, I mean, the US has an ally in there, which is Israel, obviously, which is part of this, and then you have Iran, which there doesn't seem to There's been data put out that suggests that Iran's firing has been, of missiles and drones has declined, but nonetheless it seems to still be regularly hitting all these nations around it. And the Straits of Hormuz is effectively closed. Those countries are reducing oil production, and so Iran seems to still be in the fight, so to speak. So it's very difficult to say that we're close to an end unless there's some sort of negotiation, which of course we're not privy to. Iran's president came out and said that Iran would be prepared to have negotiations, but what they need is a guarantee that there'll be no further attacks. They're particularly worried about Israel if it follows up again at some point. And they also mentioned they'd like some reparations. So I'm not sure how far anyone would get on that, but that's apparently what they told Russia and Pakistan. So, yeah, look, I mean, there is no timeline for markets at this stage.
It's interesting you talk about Israel. We saw the divergence on views between the US and Israel when it comes to the operations in Gaza. Is this an existential threat for Israel? And if so, are they likely to want to back away in the way that perhaps Trump might?
Absolutely not, Heidi. And the other thing too, which is really important, this campaign has very strong support in Israel. So it's not like Prime Minister Netanyahu is under any domestic pressure in the way that potentially President Trump is. The oil prices is big. I mean, the US is a big country. It's a driving nation. So that's always going to be a factor for any administration, whereas with Israel, exactly as you say, it is also an existential threat, one that's been hovering over them for a while. The chance to actually do something about it, and even if they don't achieve all their aims, to set Iran back a long way is only going to be beneficial for Israel. So they certainly won't be inclined to finish before they're confident they've got the job done, or in their minds, job done. But then again, they also have to be mindful of the US, which provides them with a lot of aid and military weapons and that sort of stuff. So it's going to be really interesting to see how that plays out.
The concern around the Strait of Hormuz, traffic being halted there, what are the prospects of us seeing naval or any form of escorts for vessels to traverse the waterway? I mean, we're hearing from Macron, right, that it could take a few weeks to organize any sort of escort.
Yeah, well, that's exactly right, Avril. I mean, who will do it? I mean, we've always had President Trump saying that, complaining that the US has to do all the heavy lifting for other countries. So, you're right in that sense that who would do it, but also, these things don't happen overnight as well. You've got to move assets into place and that sort of thing. But also, given the nature of war we're in now, it's not just missiles potentially being fired by Iran. It's underwater drones or above water drones or these sorts of things. I mean, the risks in trying to escort these ships through are particularly dramatic. There's also the financial side, which is obviously being worked out in terms of insurance, but it's not something that's probably particularly imminent. So. I mean, it's difficult to say at this point, but if the conflict is going to drag on, then some sort of solution will probably need to be found there.
Well, they get it to Michael Heath there. Let's get back to those markets because we are continuing to see that cross-asset declines as a result of the sustained oil price. We're seeing the WTI price pop about 7% in this session, despite, of course, reserves being released from the US, from Japan, from the IEA as well. And all of that is really not contributing to much respite for this price situation, with that focus still very much on the choke point of the Strait of Hormuz, which sees no resolution. Looking at the yen as well, where we're seeing that pretty close to the year's low, as strategists now see potentially a higher bar for intervention and perhaps also a higher bar for verbal intervention as well. But we are in that zone where we'd potentially see some jawboning from Japanese officials, but they really looked at excessive volatility rather than defending specific levels. At the moment, we're seeing quite a lot of red, including that continued sell-off across the bond market as well. This is Bloomberg.
Wednesday, The Fed decides.
Here we go again. Jay Powell only has 2 more of these meetings on the calendar.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
The potential risk scenario for the Federal Reserve is simply that they remain on hold for longer.
Certainly the Fed is no longer cutting.
Prices are going to go up. You might begin to see even more upside pressure on inflation from an already pretty bad starting point.
Is this too highbrow today?
Tune in to Bloomberg Surveillance. The Fed decides.
President Trump's administration has launched the first of several sweeping trade investigations that set the stage for new tariffs. The USTR announced it would begin a probe on alleged excess manufacturing capacity in more than a dozen major economies, including China and the EU. Our Bloomberg senior editor Derek Wallbank joins us now for more. So, Derek, in addition to everything else that's of course going on, we're also seeing the administration not let up when it comes to rebuilding the tariff wall.
Yeah, that's right, Heidi. Look, tariffs have been President Donald Trump's signature foreign economic policy. He has held this as a core belief for years and years and years. And the Supreme Court did deal him a devastating blow when it basically ruled out the authority that he had been using to sort of impose tariffs on most of the U.S.'s global trading partners, while also using the threat of those tariffs as a leverage tool to try and extract favorable trade deals. Trump was unbowed by that decision. He said that he was going to try and come back with a different authority, and that's what we have started seeing the U.S. administration do here. The authority that we're talking about is something called Section 301 authority. It basically requires an investigation to go into to basically set the stage to say that there is some long-term unfair trading practice that needs to get corrected. It is something that has a little bit more of a legal foundation under it that's a little bit more durable, according to most experts, but it does take a little bit more time. It is a little bit clunkier, I guess you might say, and it's something that we are going to see play out over the next weeks, maybe months, as these sorts of things go through. Did see a lot of names on this list. China is one of them. The European Union is one of them. India is one of them. Also, some surprises. Singapore is an example of a surprise. That's a country that has traditionally had a trade surplus with the United States and hadn't really been targeted under prior actions. So there are a couple of surprises in there.
To what extent might this raise tensions between the U.S. and China just weeks before a planned Trump-Xi meeting?
Well, it's an interesting question, Avril, because this is like a preliminary step, and the Trump administration has a ton of range of options that it can actually take, including no options, right? It could do nothing here. It could decide that it doesn't want to take action, and so that's sort of on the table. But you can kind of take this in a Chinese context. Going up to some of these meetings, you do see China sort of raise the temperature sometimes a little bit to make really clear that there are negotiating things that they have and sort of increase their negotiating hand. You could read this a little bit as the same way, but I think that the Trump administration would tell you that this is something that had been long planned. This is something that had been long telegraphed, and this is sort of a step toward that. They had wanted to pursue tariffs under another different venue that was rejected, and now this is a different venue to be able to continue that. Anyone who sort of thought that a Supreme Court decision adverse to his tariff policy was going to convert Donald Trump to the idea that tariffs are bad was just not paying attention.
Derek, thank you. Bloomberg senior editor Derek Wallbank, paying attention to these developments for us. Let's take a look at some of the movers in Japan. We have seen, of course, Softbank's Paypay setting the IPO price at $16 a share. So this is below the marketed range, and Softbank shares are slipping in early trade. But of course, this is also against the backdrop of this downdraft that we're seeing in the early goings in Japan and South Korea. More ahead on the Asia trade. This is Bloomberg. The top global headlines we're following. California Governor Gavin Newsom says he's aware of the potential for drone strikes by Iran against targets in the state. That's after reports that the FBI warned Iran has allegedly considered launching an offensive against the West Coast. The FBI has declined to comment. President Trump said to be preparing to invoke Cold War-era powers to restart oil production off Southern California. Sources say he'll soon summon authorities under the Defense Production Act to preempt state laws and ease permitting for Sable Offshore Corporation, which is looking to restart production from a cluster of offshore platforms in the state. Shares of the company surged on the back of the news. Goldman Sachs and Citigroup said to have told staffers in Dubai to stay away from their offices as Iran's attacks on Gulf cities continue. Sources say Goldman has instructed employees to seek permission before going into its branches across the Middle East. Several Wall Street banks have allowed their employees in the UAE to work remotely since the war began, with some companies also offering staff the option to temporarily leave the country. Haidi?
Take a look at what we're shaping up with when it comes to the start of trading in European futures. This, as we see the rest of Asia continue to see declines as a result of the elevated situation with oil prices, despite, of course, reserves being released by a number of countries around the world. Taking a look at these futures sessions, we are seeing downside of about 0.6% when it comes to European stocks. So we are shaping up to be another challenging session for Europe as well. In the previous session, we had stocks in the region dropping on these concerns about the war in Iran, the higher oil prices, the potential for higher interest rates. None of those factors have really changed. If anything, they have potentially worsened as we get into this Thursday session. German DAX futures also in the red there as well. Euro dollar is one to watch as we see that continued gains from the US dollar, particularly alongside the likes of the yen as well, which is what we're watching today. Some of the defence names, though, will be in focus, so because it was interesting that we saw even defence names in Germany dragging the stock 600 in the overnight session, given that we've seen potential concerns about sales, even with the ongoing war, providing something of a bump for most defence names around the world, Avril.
Yeah, Haidi, I mean, you said as much, right, that we are watching the bounce in the dollar and how that's put pressure on the Japanese currency. You're looking at dollar yen at 159.22. So we've gone past the highs of the year on dollar yen, which was in January 159.14. And this is coming along with those concerns of how vulnerable Japan is to these energy shocks, despite the release of reserves that have been telegraphed by the Takaichi administration. And this is, mind you, coming unilaterally in spite of what the IEA had signaled. We are watching banks in Japan as well yesterday coming under pressure amid these concerns about private credit cracks continuing to emerge. We did see some developments related to JP Morgan, of course, and then since then related to Apollo as well. So you are seeing that downdraft on the banks being the weight on some of these Japanese gauges. We have more ahead on the Asia trade. This is Bloomberg.
The damage is going to take months to unwind. But I want to bring it to the immediate. There is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. You know, the maximum sustainable flow rate is 2 million barrels per day. So 400, that'll take them 200 days to get that out.
Carlisle Energy Pathways Chief Strategy Officer Jeff Currie, that flow rate is what matters, which goes a long way to explain what we're seeing with these elevated oil prices, despite, of course, reserves being released by Japan, 80 million barrels, the IEA, a record 400 million barrels from its reserves, and the US, the latest one to announce 172 million barrels of oil as part of this IEA relief plan as well. None of this is really making a difference when it comes to these elevated levels. New York crude over 7% higher. We're seeing Brent crude in interestingly, when it comes to that front month futures reading, getting close to a return to triple-digit figures as well. So there is really that question, and you take a look at nat gas there, also higher, particularly an issue when it comes to the European markets, where we're seeing a near depletion of nat gas reserves there and fewer seaborne cargoes as well. Let's bring our next guest, who thinks that the war in Iran could be nearing its end. He sees oil prices at $80 a barrel this year. With us now is Neil Beveridge, who's a director of research at Bernstein. Neil, I'm going to caveat that was obviously from a couple of days ago. I do wonder if the situation has changed at all. Has the pricing aspect becomes more of a structural issue now?
Yeah, no, our view on oil hasn't changed for this year. We think still $80 a barrel, is a reasonable number. We've averaged $80 a barrel, year to date, and we could see oil prices spike, back above 120 again. But, our view is still, this is going to be, a finite duration conflict. And, even if we go back into triple digits, I think that we will see an end to the conflict in the coming weeks. And I think we will see prices normalize again, which is why we think, $80 is still, a reasonable number, for this year. But, that is not to discount the fact that we could not see Brent going back up to $120 a barrel or potentially, even higher.
Is it interesting or surprising to you at all that the reserve releases have had such a minimal impact?
No, it's not surprising. I think that, if you look at the 400 million barrel release, it's about 30% of global strategic reserves. But, you look at history and you look at the time that, we've seen SPR releases. We were about 6, over the last 30 years. And, it provides a level of, confidence to the market, but it doesn't fundamentally, result in a sustained pullback in oil prices. I mean, typically you would see a 10, 15% pullback in price, but ultimately it does nothing to change, the long-term equation. And, if you look at the kind of flow rates you'll be able to get out of the SPR, 3-4 million barrels a day, at max, that really is nothing compared with the 20 million barrels, of disruption that we've seen from closure of the Straits of Hormuz. So the only thing that's really going to bring, oil prices back down is if we really see the Straits of Hormuz reopen.
So how quickly do you think that easing in oil prices might come? To your point about the Strait of Hormuz, I mean, how much confidence does there have to be and clarity for vessels to cross the strait? And then also what we've been seeing in perhaps the worrying signs in damage to infrastructure among some of these Gulf producers. How quickly do you think things can come back online?
Well, I think in terms of how quickly we see the Straits of Hormuz reopens depends on when we see an end to the war. I think that's the only thing that's going to really result in, the reopening of the Strait. And, we've said, there's only 3 things that are going to end the war. One is that we see regime change, in Iran. That looks very unlikely right now with the new Ayatollah, with the IRG bedding in. The second thing that could end the war is one of the sides runs out of missiles. That hasn't happened yet. Could happen in a matter of weeks, maybe months, but it's not happening yet. The third thing is the markets start to rein in President Trump and the US, and I think we got a glimpse of that on Monday when Brent hit 120, and we saw him talk about this being a brief excursion and the war coming to an end soon. And I think it's going to be markets that really force Trump's hand here, and the longer this conflict goes and the higher the prices go, I think the more pressure is going to come on the U.S. to, find a solution with Iran and end the conflict. Because, if that doesn't happen, I think the economic consequences of prolonged war are going to be devastating. I think in terms of, how quickly we see, flows resume, I think the, good news here is that while we've seen pretty broad range of attacks on oil and gas infrastructure in the Middle East, Ras Laffan, Ras Tanura. Overnight we saw Ruwais hit, a number of oil terminals hit. The damage has been, I would say, limited so far. I think the drones only have a limited capacity in terms of how much damage they can inflict. And I think, you're looking at a restart of these facilities in a matter of weeks, maybe, a month, couple of months. I think the thing that I worry about more is some of the shut-ins that we're seeing in places like Iraq. Some of these oil fields rely on pressure to keep production levels high. And if we see sustained disruption to these fields, we see prolonged shut-ins, it's possible we could see reservoir damage and some of these wells might not be coming back so quickly. So really duration is the key aspect here. But I think that, if the war was to end in a matter of days or a week, I think we'd see flows really coming back to normalized levels, pretty quickly.
In the meantime, though, Neil, we're seeing how Asia economies have been struggling to get shipments of both oil and gas. Do you think there's more that they can do? I mean, this crisis has really forced the government's hand as well in terms of tapping reserves.
Yeah, I mean, Asian countries are the most impacted by this. About 85% of oil and gas flows through the Straits of Hormuz, come to Asian countries. Pakistan, India, particularly hard hit. But, you look at Japan and Korea, 80, 90% of the imports coming through the Straits of Hormuz. Now, the good thing for Japan is that they do have, a significant strategic reserve of over 200 days, so they can ride this out to some extent. China, which is the largest buyer of crude and LNG from the Middle East, again, it's built up strategic reserves, in oil, and so I think it's relatively well placed as long as this is a short duration conflict. But, the risk that we see really is, some of the secondary effects, such as, hoarding. We're seeing in some countries consumers filling up their tanks more quickly. We're seeing some companies holding back product on the expectation of higher prices. And I think that's the risk that we see sort of artificial sort of squeezes that really exacerbate the supply disruption that we've seen. So far, the response from most countries is to do things like ban, crude and product exports, so to kind of keep as much petroleum in country as possible. But as this incident continues, this war continues in duration, I think you'll start to see things like price controls and maybe even measures to curb consumption in certain places.
Will we start to see more US shale drilling? Because that hasn't really happened. Is that an element of, new capital discipline for the sector? Or is there a point where you would start to see more US activity?
In the short term, it's going to have no impact at all. So, if you decided today that you were going to start, increasing drilling, by the time you've drilled that well, completed it, brought it online, you're talking about three months, maybe 6 months. So, nothing is going to happen, in a matter of weeks that can really offset, the 20 million barrels, that we've seen disrupted as a result of this conflict.
Neil, thank you for your insights today. Neil Beveridge is Director of Research at Bernstein. Now let's take a look at how we're faring cross assets on the US names. Take a look at how S&P 500 futures are still pointing to those declines. So again, those question marks about the durability of any of the rebound we've been seeing on stocks this week. The dollar continues marching higher. We are seeing yields also rising. 424 is where the US 10-year is. More ahead on the Asia trade. This is Bloomberg. On top of the risk for markets from the war in Iran, also tracking private credit-related developments, Morgan Stanley and Cliffwater have capped withdrawals from some private credit funds after investors tried to cash out more than the vehicles allowed. Bloomberg Asia credit editor Finbar Flynn joins us now from Tokyo. Finbar, good to see you. I mean, we want to talk about these risks in private credit because we see increasingly stories a bit concerning in that development. What's going on?
Hey, good morning. Yes, private credit is finding itself really in a storm. We had a story yesterday with PIMCO president calling it a crisis of confidence, but also a crisis of bad underwriting. So the main problem here is that many of these assets of private credit, which expanded hugely in the last couple of years, were put into these retail-focused funds, retail-facing funds, and this is an illiquid asset. It's meant to be a loan to these rather, speculative grade companies or even less. But now retail investors are concerned about some of these loans. They're concerned about AI's impact on software companies who have got a lot of these loans. So they're trying to take out their money, and that's causing hardship for these funds.
What are the most concerning developments that we're seeing at the moment?
So yesterday we had a really big story. I think we saw JP Morgan, which is a huge lender, saying that it's restricting some of the lending to these funds, these private credit funds. It's the banker of some of these funds, and that's because it's also looking at the underlying assets in some of these funds, and it sees the exposure to software that people cannot yet fully appreciate, and it marked down some of those loans. So it's limiting what it's giving some of these funds. I should say it says that's to a small number of companies, but still it's very worrying when a bank that size reduces its lending to this sector.
So are we yet seeing any impact on the broader public credit markets?
So we have started to see this shake through to the broader market. I should say that the spreads haven't widened a huge amount. It's coming at a really bad time, however, because you have the Iran war going on, yields are rising. So it's all, it's really a perfect storm. And the fear is that, it will affect maybe public markets in terms of the lower rated companies, but it's still pretty stable in those markets. We're not seeing too much pain there yet.
We're watching pain for Japanese banks in today's session, but where in the region do you see the vulnerabilities?
So Asia is actually quite interesting because private credit didn't really take off here as much as it did in terms of the lending here in Asia. The exposure in terms of companies is less. But you raise a very good point, because these funds, these retail funds for private credit, are also sold here in Japan. They're sold to Japanese investors, they're sold to investors elsewhere. So we're keeping a close eye on what these funds to retail investors here in Japan and elsewhere in the region, how investors are doing there.
Bloomberg Asia credit editor Finbar Flynn there in Tokyo. Well, speaking of Japan, take a look at what we're watching when it comes to one of the sort of few gainers that, or good news stories that we continue to follow, and that is Nintendo at the moment. We're seeing pretty flat trading at the moment, but there has been sort of quite a bit more excitement when it comes to the Japan gaming space in particular, given that we have seen Pokemon at the front of the fall when it comes to that enthusiasm. Our Bloomberg senior equities reporter Hideyuki Sano joins us now from Tokyo. So, other than trying to catch them all, what are we seeing as the drivers of investors being interested in gaming shares?
Right. So the war the US and Israel started against Iran has made investors rethink their stock picks. And because higher oil prices are the primary concerns of at the moment, there's looking for ways to cushion blow. And if you look around, gaming companies look like a very good investment now, because the energy accounts for a very small portion of their costs, and their demand is unlikely to take a big hit by higher oil prices. So, of course, valuation of these companies have fallen quite sharply over the past 6 or 7 months. And of course, there's reason for that. One is fear of AI disruptions, and soaring memory chip prices have also hit console makers such as Sony and Nintendo. But content creation at the moment is seen as something of a buffer against geopolitical risks.
Yeah, talk to us about those concerns related to AI disruption, because essentially it makes things easier for gaming creation in terms of the software. Is that seen as a potential headwind somewhere down the line for these Japanese gaming companies?
Yes, exactly. And I think this is where the conversation gets very interesting. As you say, it has become so easy to create online games today. But just yesterday, as Haidi mentioned earlier, we saw Nintendo share prices soaring just because one of its Pokemon games performing quite well. It's good old Pokemon. It's been around for many years, but people still love it. And if you look around, there are thousands of games out there, but people still prefer Pokemon and other familiar characters over some unknown characters. To some investors, this is a testament of the strengths Japanese game companies have in their intellectual properties. And there's another argument. Even if some AI-generated games may make their way into marketplace, that doesn't necessarily mean suddenly Nintendo's games become obsolete. One fund manager gave me a very interesting analogy. So now we may have some AI-generated songs climbing the Spotify rankings, but that doesn't mean people stop listening to Taylor Swift. And the same applies for gaming companies. So at the moment, some investors are starting to think this AI fear, the talk of AI disruption might be a bit overblown, and that it's a good time to start bargain hunting.
Hideyuki, this is a really great taking stock piece that you've pushed out. Interesting, right? How Pokemon has that enduring appeal. Our Bloomberg senior equities reporter Hideyuki Sano in Tokyo for us. More ahead on the Asia trade. This is Bloomberg.
There's a longer-term trend, and most industry observers have been focusing on all of the stimulative effects of AI, all of the capital investment, the jobs, the demands for power, data centers and the like. But the reality is where there's creation over here, there's disruption, destruction over here. And I don't think the market has fully appreciated that it's not necessarily a soft landing to get from all the growth and investment and world-changing capabilities of AI, but there's going to be a lot of roadkill left behind.
PJT Partners Chairman and CEO Paul Taubman there speaking exclusively with Bloomberg earlier in New York. Well, sticking with tech and looking ahead to the open in China, we'll be watching very closely shares of Baidu and other names linked to the OpenClaw craze after their ADRs slipped on Wall Street. Our Asia Tech correspondent Avril joins us now. So is the mania showing signs of petering out?
Yeah, it's a difficult one to say. I think at the individual consumer level, we can't probably judge that just yet. But I do think when it comes to the stock story, that is actually one that's a little bit more clear cut, because I think that there is sort of a case to be made that yes, the rally or the heat has come out of the stock somewhat. I think that was really notable in ADRs, and we saw, for instance, the likes of Tencent, Baidu, their trading was very much impacted on the Wednesday session. So we did get a Bloomberg scoop out relating to the security concerns rather, so we can get more on that in just a moment. But I do think for Baidu in particular, it's quite a good litmus test, essentially, of the interest in this, because just in the last few hours, they've actually released their own OpenClaw model, or one that's compatible with OpenClaw, essentially called DoClaw, and you can get access to that for about $2.50 a month. It's a similar move, of course, that we've seen from the likes of Minimax, from Tencent, and that was enough to spark a rally in those stocks. But at the same time, when it comes to Baidu, it didn't really lift the company trading at all, because you saw it, again, you can see there in the red in ADRs on Wednesday. So, of course, the fundamental story of Baidu is looking quite challenged. There's a lot of concerns around how much they can actually get ROI on their AI investments and the broader outlook for the business. But yes, that is sort of a good example, I think, and maybe an indication of where we will go in trading activity from here.
You talked about some of these security concerns, and tell us more a bit about the regulatory scrutiny in China this has drawn as well.
Yeah, well, this was a very big story in the last few hours as well. So we had a Bloomberg scoop on this, and what we're hearing is that Chinese authorities have moved to restrict employees at state-owned enterprises, government agencies from running OpenClaw AI apps on office computers. So that does include actually the largest banks in the country as well. So it does, what we understand from our sources, come down to security reasons, and actually broadly with OpenClaw there are a lot of security concerns, and some of the cybersecurity experts we've spoken to are saying that this is a bit of a lethal trifecta essentially, because you're giving OpenClaw access to a lot of data. It's got the ability to communicate externally, and it can also, or it is exposed to untrusted content. So there are overall security concerns, but certainly security concerns in China, given you've got President Xi Jinping long seeing data as a core pillar of his flagship holistic approach to national security. It's I guess, perhaps unsurprising that they've taken this step, but again, something that did really impact trading sentiment, because we saw Tencent, for instance, giving up its gains intraday, and you saw that flowing across onto Wall Street overnight.
Avril is there with really one story that we could see continue to play out when it comes to trading in the tech space across Greater China as we head into that market open in the next hour or so. Tech futures are there when it comes to Hang Seng Tech futures are down by just about 0.4%. We've got some other crosswinds as well. Atlassian planning to cut 1,600 jobs again. They're citing the shift to AI changing the needs of their labour force as well. TAIEX futures off by 1%. Taiwanese stocks could be a little bit more vulnerable for that reversal lower, given that we saw a jump of 4% on Wednesday. So perhaps an underperformer, even compared to the sell-off that we're seeing take place across its Asian peers as well. Since the TAIEX close, we've seen WTI oil prices climbing roughly $9, so that's likely to provide an extra jolt of downside sentiment, Avril.
Yeah, the jolt coming from the energy prices, right? You're seeing Brent WTI still pulling about 7% higher. So despite what we're hearing on these release of reserves, that's really not helping to calm the markets. What is slipping in commodities, though, is gold prices, 51.50 thereabouts, as perhaps investors pare back their bets of Fed rate cuts for this year. Markets now pricing just one, amid the concerns about energy driving inflation. That's it from the Asia trade. This is Bloomberg.